Good afternoon, class, or good morning, or good evening. I don't know where you are, but I am in the state of Michigan, that is in the United States. And here it is 4:24 p.m. So good afternoon to you, and welcome to Finance in a Global Perspective, known as BSMM-8120. So today we will cover chapter 1 that deals with globalization and the multinational firm. And here's an overview of what is going to be covered. We will try to answer this important question. What is so special about international finance? What are the goals for international financial management? What about globalization of the world economy? And then we will clearly define multinational corporations. What are they? So let's get started without any further delay. What is so special about international finance? You may want to ask. Well, three major dimensions set international finance apart from domestic finance. One, foreign exchange risk and political risk, market imperfections, and expanding opportunity set. These three dimensions set international finance clearly apart from domestic finance. And these dimensions largely stem from the fact that sovereign nations have the right to issue their own currencies, formulate their own economic policies, impose taxes, and regulate the movements of people, goods, and capital across their borders. Now, foreign exchange risk is the risk of facing uncertain future exchange rates. In addition to businesses, individuals and households may also be seriously exposed to uncertain exchange rates. Exchange rates among the major currencies, such as the US dollar, the Japanese yen, and so on and so forth, would tend to fluctuate continuously in an unpredictable manner. We note in passing that exchange rates were fixed up until the early 70s, when late President Nixon, Richard Nixon, decided to move away from the system of fixed exchange rates. And since then, exchange rates have been mostly fluctuating. Exchange rate uncertainty influences all major economic functions, including consumption, production, and investment. Here, we're looking at the monthly exchange change. We're looking at the monthly percentage change in the Japanese yen US dollar exchange rate. You can see once again that up until the early 70s, the exchange rate between the two currencies was fairly stable. Then started in the mid 70s, right? The exchange rate between the two currencies started to fluctuate rather widely. Okay. Now, political risk arises from potential losses to the parent firm resulting from adverse political developments in the host country. Political risk ranges from unexpected changes in tax rules to outright expropriation of assets held by foreigners. And this happened in Venezuela when late President Hugo Chavez was in office. Political risk arises from the fact that a sovereign country can change the quote-unquote rules of the game, and the affected parties may not have effective recourse. Political risk is especially relevant in those countries without a traditional rule of law. Market imperfections. These may be described as various frictions, such as transaction costs and legal restrictions that prevent the markets from functioning perfectly. World markets are highly imperfect. Numerous barriers hamper the free movement of people, goods, services, and capital across national boundaries. For example, legal restrictions exist, excessive transaction and transportation costs, that's another issue, information asymmetry, and discriminatory taxation. All these factors create imperfections in the market. Market imperfections restrict the extent to which investors can diversify their portfolios internationally. Now, the example of Nestle is very important. This is an example of market imperfection. Now, Nestle used to issue two different classes of common stock known as bearer shares and registered shares. Now, foreigners were only allowed to hold bearer shares, while the Swiss residents could buy registered shares. But get this, the bearer stock was more expensive. So foreigners were in effect paying more for a share of the same company. Now, on November 18th, 1988, Nestle lifted restrictions imposed on foreigners, allowing them to hold registered shares as well as bearer shares. And as a consequence, the price spread between the two types of shares narrowed rather drastically. And we see that in this table. We see that in the following table. You can see here, right? Up until December of 1988, see, bearer shares were pricier. They were more expensive compared to registered shares. But then once the restriction on foreigners was lifted, you can see that the two shares converge in prices. They started to move in tandem. Firms may benefit from an expanded opportunity set when they venture into the arena of global markets. Firms can gain from greater economies of scale when their tangible and intangible assets are deployed on a global basis. This is true for corporations as well as individual investors. As the saying goes, it just doesn't make sense to play in only one corner of the sandbox. Okay. Now, what are the goals for international financial management? Well, the focus of the text is to provide today's financial managers with an understanding of the fundamental concepts and the tools necessary to be effective global managers. Thus, the fundamental goal of sound financial management is a shareholder wealth maximization, which means that the firm makes all business decisions and investments with an eye toward making the owners of the firm, that is the shareholders, better off financially. Viewing shareholder wealth maximization as a primary goal of financial management is generally accepted in Anglo-Saxon countries, but not as widely embraced in other parts of the world. In other countries, shareholders are viewed as merely or as simply one among many stakeholders of the firm. The other stakeholders being the employees of the firm, the suppliers, yes, the supply chain is important, the customers, and the banks. We find a very interesting example in Japan. In Japan, managers have typically sought to maximize the value of the keiretsu. The keiretsu is a family of firms to which the individual firms belong. So as a manager, your job is to try and maximize the value of the family of firms, not simply the value of your own individual firm. Corporate governance, as shown by a series of recent corporate scandals at companies like Enron, WorldCom, Parmalat, and Global Crossing, managers may pursue their own private interests at the expense of shareholders when they are not closely monitored. This creates an agency problem, right? This creates an agency problem. This agency problem is a major weakness of the public corporation because with the public corporation, the owners are not the managers. There's a separation, right? So corporate governance defined as the financial and legal framework for regulating the relationship between a firm's management and its shareholders is crucially and critically important in solving agency problems. Now we turn our attention to the globalization of the world economy. And here we are going to examine some of the major trends and developments in the world economy. We will touch on the emergence of globalized financial markets. We'll discuss the emergence of the euro as a global currency. We'll talk about Europe's sovereign debt crisis. This occurred in 2010. We'll talk about trade liberalization and economic integration. We'll talk about privatization, the global financial crisis of 2008-2009, and finally, we'll comment very briefly on Brexit. So let's start with the emergence of globalized financial markets. The deregulation of foreign exchange and capital markets, this was a significant development in the globalized financial markets. Financial innovations resulted in the introduction of several financial instruments. And here we're thinking of instruments such as currency futures and options. We'll talk about these. Multi-currency bonds are also going to be discussed. International mutual funds, country funds, exchange traded funds, foreign stock index futures and options. Okay. Another important trend in the globalized financial market had to do with the significant advances in computer and telecommunications technology. What about the emergence of the euro as a global currency? This was a momentous event in the history of world financial system. That's the introduction of the euro, or the development of the euro, was a momentous event. Now currently, more than 300 million Europeans in 19 different countries are using the common currency on a daily basis. They're using the euro. Okay. Now you're looking at countries ranging from Austria, Belgium, all the way to Spain. The transaction domain of the euro may become larger than that of the US in the future. At least that is what some economists now believe or project. Let's touch a little bit on the Europe's sovereign debt crisis of 2010. Now, it all started in December 2009. In December 2009, the new Greek government revealed that its budget deficit for the year would be 12.7% of GDP, not the 3.7% previously forecast. What happened then as a consequence of that revelation? Well, investors panicked. Investors started to sell off Greek government bonds, and the ratings agencies downgraded those bonds. They downgraded the Greek bonds to junk status, meaning that the bonds were of very poor quality. Okay, the panic spread to other weak European countries, especially Ireland, Portugal, and Spain, and quickly escalated to a Europe-wide debt crisis. The Greek debt crisis revealed a profound weakness in of the euro as the common currency. You see, the lack of fiscal discipline in a eurozone country can always trigger a Europe-wide crisis. So clearly, this is a weakness. As this graph shows, uh, Greece paid a minimal or practically non-existent premium above the German interest rate up until about December 2009. See, December 2009. The two interest rates did not diverge by a significant amount. Okay, but after that, the story was completely different. The Greek interest rate, you can see here, rose sharply, right, until the bailout package was announced on May 9th. See, trade liberalization and economic integration. The principal argument for international trade is based on the theory of competitive advantage, okay, which says that it is mutually beneficial for countries if they specialize in the production of those goods and services they can produce most efficiently and trade those goods among them. The policy implication is that liberalization of international trade will enhance the welfare of the world's citizens. Over the years, international trade has been liberalized at both the global and regional levels. The General Agreement on Tariffs on Trade, known as GATT, is a multilateral agreement among member countries that has reduced many barriers to trade. The World Trade Organization, WTO, has the power to enforce the rules of international trade. But regional arrangements have also been instituted to promote economic integration. The European Union, EU, for example, includes 28 member states that have eliminated barriers to the free flow of goods, capital, and people. The North American Free Trade Agreement, known as NAFTA, called for phasing out impediments to trade between, or I should say among, Canada, Mexico, and the United States over a 15-year period beginning in 1994. However, in November 2018, the three countries signed a new accord known as the US-Mexico-Canada Agreement, or USMCA, and by March of 2020, all three countries had ratified the new agreement. The USMCA took effect on July 1st, 2020, thus replacing NAFTA. In Mexico, the ratio of export to GDP has increased dramatically from 2.2% in 1973 to about 35.6% in 2017. Now, here are a few recent free trade agreements. The Trans-Pacific Partnership, or TPP, is designed to slash tariffs and facilitates trade among 11 Pacific Rim member countries. It was signed in March of 2018. The US withdrew from the pact, citing President Trump's America First philosophy. Another recent free trade agreement worth discussion is the African Continental Free Trade Agreement. It aims to stimulate intra-African trade and investment by reducing tariffs, protecting intellectual property rights, and lowering barriers to migration. As of August 2020, 54 African countries had signed the agreement. On December 4th, 2020, Nigeria became the 34th country to ratify this agreement, or the African Continental Free Trade Agreement. Privatization. What is it? Privatization is the act of a country divesting itself of ownership and operation of business ventures by turning them over to the free market system. Privatization may be described as a denationalization process and often viewed as a means to an end. It involves selling state-owned businesses to bring in hard foreign currency reserves to the national treasury. Privatization is often seen as a cure for bureaucratic inefficiency and waste. Some economists estimate privatization improves efficiency and reduces operating costs by as much as 20%. A special case is that of China. So let's comment on the Chinese privatization. In China, the state-owned enterprises, or SOEs, have been listed on organized stock exchanges, making them eligible for private ownership. China launched 2 stock exchanges in the early 1980s. As of 2018, approximately 3,600 companies are listed on China's stock exchanges. A shares are primarily reserved for Chinese citizens, while foreigners may invest in B shares or H shares. The Chinese government still retains the majority stakes in most public firms. Let's comment very briefly on the global financial crisis of 2008-2009. What are the factors that drove the financial crisis? Well, households and financial institutions borrowed too much and took too much risk. The crisis was further amplified and transmitted globally by securitization. Financial engineers designed opaque and complex mortgage-backed securities that could be used for excessive risk taking. The invisible hands of free markets apparently failed to self-regulate excesses, thus contributing to the banking crisis. International financial markets are highly interconnected and integrated, so that once a crisis starts in one country, it is likely to be transmitted to other countries. My own research, that is the speaker, that's your instructor. I've done a lot of work in the area of market integration. Okay? My own work confirms or validates world market integration. I'll be sharing my research with you if you are interested. Here we're looking at the US unemployment rate and the Dow Jones Industrial Average. You can see the impact of the Great Recession here. Okay, during the Great Recession, you can see that the US unemployment rate shot up and then it increased dramatically at the same time that the stock market was plummeting. Okay, so they were moving in opposite directions as expected. Brexit, finally. What is Brexit? Brexit describes the voting decision on June 23rd, 2016. I remember that I was in class the day that this vote was taken. Yes. So Brexit describes the voting decision on June 23rd, 2016 of a majority of Britons to leave the European Union and the European Atomic Energy Community at the end of uh, January 31st, 2020. It was speculated that Brexit will weaken the United Kingdom and the European Union, both economically and politically. It was also speculated that that the position of London as a dominant center of European finance may deteriorate if the UK loses unrestricted access to Europe's single market. Now, one important question that I often get asked, or often asked, is how did this happen? How did we get to Brexit? Well, a majority of voters outside of London felt alienated from the globalized economy and were worried about competition for jobs from immigrants. 60% of Londoners voted to remain in the European Union. 45% of voters in the rest of England voted the same way. Ironically, though, Brexit occurred because globalization appeared to have worked. London emerged as the capital of European finance as European integration was deepening, which tremendously benefited London. But the rest of the country did not share much of the fruit of this success. Finally, as I'm briefly mentioned in the introduction, it is important that we know what multinational corporations are. Okay? A multinational corporation, or MNC, MNC is a firm that has been incorporated in one country and has production and sales operations in other countries. Approximately 60,000 multinational corporations in the world. There are approximately 60,000 multinational corporations in the world with over 500,000 foreign affiliates. Multinational corporations benefit from the economy of scale in many ways, spreading research and development expenditures and advertising costs over their global sales, pooling global purchasing power over suppliers, utilizing their technological and managerial know-how globally with minimum additional cost. My dear friends, that is the introduction to finance in a global perspective. That is all that I have to share with you as far as chapter goes. So that's all I have to share with you as far as chapter 1 goes. Until I come to you again, take care of yourselves and be well.